constantly changing the strategy. The essence of simple investing is broad diversification, low cost, long-term, regular investing. But most investors change their strategy after 6 months, switch to the latest, trendy product, disrupt their system by saying, "This fund looks better." As seen in the work of Richard Thaler, people are more inclined to break plans than to stick to them. The biggest enemy of simple investing is inconsistency. Trying to time the market. Let it drop a bit, then I'll buy. It has risen too much, I'll wait. This mindset contradicts the philosophy of simple investing. Research by Vanguard Group shows missing the best days significantly reduces long-term returns. For example, when S&P 500 data is analyzed, investors who miss just a few of the best days experience a dramatic drop in performance. Simple investing is built on consistency, not timing. Overchecking the portfolio. In theory, the simple investor believes in the long term. In practice, they check their portfolio 5 times a day, panic during declines, get overly excited during rallies. The concept of loss aversion, introduced by Daniel Kahneman and Amos Tversky, shows that frequent checking increases the perception of loss. This leads to unnecessary selling, off-plan decisions, emotional reactions. The power of simple investing lies in minimal intervention. Over-diversification. Simple investing may mean a balanced structure of 3 to 5 core components. But some investors hold 20 funds, own 30 stocks, add 10 different themes, and turn simplicity into complexity. This creates monitoring difficulty, unnecessary costs, strategic confusion. Simple investing requires clear, manageable structure. Impatience. The core engine of simple investing is compounding. But compounding looks slow in the early years, accelerates over time. Most of Warren Buffett's wealth was accumulated after age 50. Yet most investors expect big results in 3 to 5 years. This leads to quitting too early, abandoning strategy, the belief that this isn't working, breaking the strategy during market crashes. The hardest test of simple investing is a market crash. For example, the 2008 financial crisis, the 2020 pandemic decline. During these periods, many investors sold at the bottom, abandoned their strategy. But the logic of simple investing is this: declines are part of the system. Historically, downturns have been temporary. Long-term growth trends have been persistent. Underestimating costs. One of the core principles of simple investing is low cost. Yet investors often ignore high management fees, frequent trading commissions, tax impact. Small cost differences can turn into large compounded losses over time. Social media and trend influence. The most dangerous area for a simple investor is get rich quick stories, stock of the year, narratives, crypto or thematic hype cycles. Simple investing is boring. It is not fashionable. It does not chase trends. But investor psychology seeks excitement, and that disrupts the system. The real mistake, making simple investing complicated. The biggest paradox is this: because simple investing is easy, the human mind assumes it is insufficient. So investors build more complex systems, perform excessive analysis, intervene too frequently. Yet academic research and passive fund data show simple system plus discipline outperforms complex system plus emotional intervention. Summary: the 10 most common mistakes. Changing strategy, trying to time the market, checking too frequently, over-diversifying, impatience, panic selling during declines, ignoring costs, chasing trendy investments, being influenced by social pressure, breaking discipline. Conclusion: the success of simple investing depends less on knowledge level and more on behavioral quality, patience, consistency. The real question is my strategy truly simple, or am I the one making it complicated